Welcome back to the Microlearning Institute. In this tutorial, we're going to look at a question called savoir. This question deals with many aspects of IAS 33 earnings per share, including how to deal with a share issue at full market value, how to deal with a bonus issue, how to deal with a rights issue, and also how to deal with a convertible loan and share options. And we're going to look at the calculation of basic and fully diluted earnings per share in all of these cases. So, firstly, let's look at year ending the 31st of March 20x4. And the most important thing in all of these type of questions is to understand the timeline and when within that timeline the shares were issued and under what circumstances. So, from the 1st of April X3 to the 30th of June X3, that's a 3-month period, we had 40 million shares in circulation. Then, on the 1st of July and running all the way to the 31st of December, which is a period of 6 months, we had a full issue at open market value of 8 million shares. So cumulatively, the number of shares in circulation for that period increased to 48 million. And then on the 1st of January X4 to the 31st of March X4, that's a 3-month period, we also had a bonus issue, a 1-for-4 bonus issue. And of course, given that there were 48 million shares in circulation already, a 1-for-4 bonus issue resulted in an additional 12 million shares being issued, giving us cumulatively, for the last 3 months of the year, 60 million shares in circulation. So now we know how many shares were in circulation and for what time periods within the year these shares were in circulation. So this allows us now to calculate the basic earnings per share for the year end, the 31st of March 20x4. So firstly, let's look at the first period from the 1st of April to the 30th of June X3. The number of shares, as we said, was 40 million for a 3-month period. Now those shares became eligible for the bonus of the bonus issue, and that bonus was 5-for-4, because of course it was 1 additional share issued for every 4 the shareholder already had. So therefore the shareholder would have finished with 5 shares for every 4 they already had. So this accumulates to a time-weighted average number of shares for this period of 12.5 million shares. Next, we look at the period from the 1st of July to the 31st of December, and as we've calculated earlier, we had 48 million shares in circulation for that period. That is a 6-month period, and of course also those shares became eligible for the bonus, and again were multiplied by the bonus fraction of 5/4. So the time-weighted average number of shares for this period is 30 million shares. Now the final period we're going to look at is the period from the 1st of January to the 31st of March, and of course we simply had 60 million shares in circulation for that period, which is a 3-month period, and the time-weighted average effect of those shares is 15 million shares. So totally, our total weighted average number of shares in circulation for the year is 57.5 million shares. Now we're told in the question that the earnings for the year were $13.8 million. So our earnings per share can be calculated by dividing the earnings by the weighted average number of shares, and that tells us that our earnings per share is 24 cents. The prior year earnings per share were 25 cents, and if we want to restate the prior year, we need to multiply by the reciprocal of the bonus fraction. Now the bonus fraction is 5/4, so the reciprocal of that is 4/5. So if we look at the prior year's stated earnings per share and multiply it by 4/5, we can conclude that the restated prior year's earnings per share is 20 cents. Next, let's have a look at the activities of the 31st for year ended the 31st of March 20x5. Again, from the 1st of April 20x4 to the 30th of September 20x4, we had again a 6-month period, and we have, if you'll recall, from the year ending the 31st of March x5, or the prior year, we have 60 million shares in circulation. Now, from the 1st of the 10th x4 to the 31st of the 3rd x5, an additional 6 months, we had a rights issue, a 2-for-5 rights issue. And of course, a 2-for-5 rights issue with 60 million shares already in circulation resulted in an additional 24 million shares being issued, meaning that cumulatively we had 84 million shares in circulation from the 1st of October X4. Now, as soon as we see a rights issue, we need to calculate the theoretical ex-rights price, or the TERP. Okay, so this, before the right was issued, so pre-rights, we're saying that each of the shareholders would have held 5 shares, and the value of those shares on the day the right was issued was $2.40 per share. So in total, each shareholder would have had $12 in value. Now, we then gave the shareholders the right to purchase an additional 2 shares at a reduced price with respect to the market value of $1. So we gave them the right to have an additional $2 of value. And of course, ex-rights then, if they originally had 5 shares and we were giving them the right to purchase 2, after the right has been exercised, they will have 7 shares. And theoretically, the value of those shares should be the sum of 12 plus $2, which is $14. So consequently, the theoretical ex-rights price is $2. And this gives rise now, again, to a bonus fraction. And the bonus fraction is the share price pre the right versus the theoretical ex-rights price. So that's 2.4 over 2. We can now move ahead and calculate the basic earnings per share for year ended the 31st of March X5. So again, the period 1st of April X4 to the 30th of September X4, we had 60 million shares in circulation for a 6-month period, and of course they became subject to the rights issue, or the bonus element of the rights issue. So once again, we multiply them by that bonus fraction of 2.4 over 2. So the time-weighted average number of shares in circulation for that period is 36 million shares. From the 1st of October X4 to the 31st of March X5, you will recall that we calculated we had 84 million shares in circulation for that period, and that period is a 6-month period. Now those shares came into circulation post the rights issue, so this calculation is not subject to the bonus fraction of the rights issue. So the time-weighted average number of shares for that second 6-month period is 42 million shares. So our weighted average number of shares in total is 78 million shares. Once again, we're told that the earnings for the period are 19.5 million. If our weighted average number of shares is 78 million, then the earnings per share for year ended 31st of March X5 is 24 cents. Again, we can restate the prior year's earnings per share by multiplying by the reciprocal of the bonus fraction. And again, the prior year's earnings per share is 24 cents, and we multiply by the reciprocal of the bonus fraction, which is 2 divided by 2.4. So our prior year restated to the same basis is 20 cents. Next, we can look now at the diluted earnings per share for year ended the 31st of March X6. We're told in the question that the earnings for basic are $25.2 million, and the number of shares in circulation, as we know, is $84 million. So the basic earnings per share for year ended the 31st of March X6 can be calculated at 30 cents in the usual fashion. Now, we have a number of potential shares that may come into circulation, and of course it's these potential shares that give rise to the concept of a diluted earnings per share. The first source of potential shares is the 8% loan note. So right now the company is paying interest on the 8% loan note. So if that loan note is redeemed, the company will then no longer have to pay interest, and of course the interest charged on that loan note is the $20 million value of the loan note by the 8%. But of course the earnings figure attributable to earnings per share is the after-tax earnings. Now we're told that tax in this jurisdiction is charged at 25%, so the savings after tax will only be 75% of the interest that is being paid. So consequently, if this loan note is redeemed, the earnings will increase by $1.2 million. Similarly, if the loan note is redeemed, the terms of the redemption is that we issue 50 shares for every $100 of loan note. So there we see the calculation, looking at the total $20 million of loan note, dividing it by $100 to see how many $100 units are in it, and multiplying it by 50 shares. And the number of shares that will have to be issued are 10 million shares. So on redemption of the loan note, our diluted earnings will become the sum of 25.2 million and 1.2 million, which is 26.4 million. And our number of shares will become the original 84 million plus the additional 10 million that would need to be issued to redeem the loan note, bringing our total number of shares to 94 million. So our first dilution is to 28 cents. The next item that causes a potential issue of shares are the share options that have been issued to management. Now, if those share options are taken up by management, there's actually no expense to the P&L for that. However, there will be an additional number of shares issued, and again we need to go and look at a working as to how we calculate that. And of course you'll remember that we're interested in the free shares that are issued, not necessarily the shares that are issued at the full market value, which of course would be included in the basic earnings per share. So let's have a look at this working. So if we do issue these options, these 12 million options, management will pay $1.50 each, so the proceeds of this options issue will be $18 million. Now that's equivalent to an issue, because again, given that fair market value is $2.50, that's equivalent to issuing 7,200 shares at a full market value. Now in total, of course, we've issued 12,000 shares, so if 7,200 of them are deemed to be issued at full market value, then we can say that the balance, i.e. the 4,800 shares, are deemed to be issued free of charge. And of course it's these potential shares that are issued free of charge that have a diluting effect on our earnings per share. So now we can go back to our original table and say that even though the earnings are not affected by the issuing of the options, we do have effectively an additional 4,800 shares in circulation. So that will increase for fully diluted earnings per share. Our earnings will still stay at $26.4 million. Our number of shares will stay at 98.8. So consequently, our updated, fully diluted earnings per share can now be calculated at 26.72 cents per share. Thank you very much for watching this short tutorial on IAS 33 from the Microlearning Institute.